Hey everyone, welcome to the final bar, a historical sell-off today. Another tough day and a tough week and a tough month for the financial markets, with equities selling off fairly aggressively through most of the day. Fed came out midday with some sort of support, but it faded going into the close. My guest Julius is going to help us make sense of all of this from a rotation perspective, think about sectors, assets, and how they're related. Also a mystery chart and a deeper look at breadth. So ladies and gentlemen, this is the final bar. Hey everyone, welcome to today's show, The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com, normally in Redmond, Washington, but as with many in the Pacific Northwest, much of the country and now obviously much of the world, doing some social distancing and most of us working from home. So thanks for your patience for StockCharts TV as we adapt to this new reality. Make sure we keep giving you great coverage, great content, and great thoughts from all the places around the world that we are this week. Today, as I mentioned in the intro, a historic sell-off among historic sell-offs, this downtrend. I was talking to one of my friends, Dan Russo, who's a morning show for us on StockCharts TV, and we talked about just the severity of the sell-off, how much it feels not like 08, 09, but more like 2001, 2002. Both of us were in New York at the time and dealing with 9/11 and a lot of the fears and just the relationship of the market environment there, and how fear, how the panic, how the emotional state manifests itself into equity prices and other assets. So a lot of interesting charts to look at today. We're excited to go through them with you. But before we get to that, I did want to share with you a lot of great content coming up on StockCharts TV and on our show today. We have Julius Kempenaer helping us recap the markets, put today's movements into proper context. On Monday, our next episode of Behind the Charts is going to feature a conversation we had with Jeff Huge. He's the CIO at JWH Investments in Minneapolis. Had some really good thoughts about technical versus quantitative fundamental analysis altogether. You're not going to want to miss that. Then later next week, we have Tim Tashler on Tuesday the 17th, then David Auerbach, an expert in real estate and REITs. Then on the 19th, Cliff Droke. So we have some really good guests. And again, in an environment like this, it's all about trying to put things into proper context, trying to understand how things relate to one another. And on that note, I want to bring in our good, one of our very good friends from Europe, Julius Kempenaer. Julius, thank you for joining us on the show today.
Yeah, Dave. I'm not sure if I should be glad to be here, but it's for sure.
Sorry again for inviting you on today, but thank you so much for helping us.
Yeah, we had this planned for a while already, but the timing is great. I mean, what a day, guys! This is crazy. We got like 8 minutes, I believe, and I don't even know where to start because my head is still spinning of all the things that I saw flying by today. Let's try to do it in a little bit structured way. And as Dave said, days like this, it's easy to lose yourself in small little details. So I'm going to try to bring it into a little bit more perspective. And as you know, that I'm a heavy user of relative rotation graphs, and they are perfectly suited to help us paint the big picture and see where everything goes and how everything interrelates. If we do a quick round around the markets, then the dashboard at StockCharts.com is a great help. The equity markets, about 10% lower, Dow, S&P, NASDAQ, all just shy of that 10% level. Small caps really getting hammered with over 11%. And well, the only rise, VIX at 76.24. That's, I'm not sure if it's an all-time high, but for sure it is a very high level. If we go to the bond market, we see that yields are rising, are dropping, so prices are rising. And if you look at the percentages, I was just thinking about it, that a lot of people think that bonds are safe havens, but with yields so low, a small move in price gives you a very big percentage move. So that's definitely something that I want to point out to people, that to be careful about, because these things can get really, really ugly if it goes the other way around. Commodities getting hammered, the energy complex very, very weak for a long time already, and no other things than today. So gasoline, nat gas, like really crazy down. Let me quickly go to the sectors. There's a little bit more of my home turf. And what I want to do here is I want to bring in the RRG for the sectors. And where is that? I put that right here, and I give the quick rundown. You see in the green, I got the daily RRG here, and you see that the defensive stuff like staples, healthcare, utilities, believe it or not, technology is actually doing really, really well in this time. So you wouldn't expect that it's a defensive, but it's certainly acting like one. Communication services right in the middle. And now we got real estate, which supposedly is defensive, but it's got hammered down the last few days. And then in the lagging quadrant, we got the usual suspects like energy, financials, industrials, materials, discretionary. They're all really, really getting hammered. So it's very much a market where people are looking for safe havens, and those are the defensive sectors, and you see them listed here. If I go to the international markets, to put everything in a little bit more international perspective, we can look at the international stock indexes on an RRG. And I talked about that in Sector Spotlight Tuesday earlier this week, and I showed the same chart. And what puzzled me here is that China is one of the best, if not the best market around from a relative perspective. I mean, it's still down, but if you look at the percentages, you can see that in the table below the RRG, China is only down 3.4% over the last 5 days. Whereas like Europe, my home turf, is down almost 23%. That is a very, very big difference. Let me run down a couple more. So this is China. Here is Hong Kong doing pretty well. This is South Korea doing pretty well. This is Mexico doing pretty well. Indonesia, India rolling over. So that's here it's starting to roll over. But the first 5 markets are doing really, really well. And I am, well, sort of tracking the news, but China, Hong Kong, South Korea, those are names that ring a bell when it comes to the coronavirus. That's where it started. That's where everything started to collapse. And now, over the last 5 days, these are the best markets around. And then if you go down the list, we see the Nikkei is actually turning around. So right in the middle, not sure what to think of that. Seems to be going the right direction now. The S&P 500 is actually improving. It's going in the right direction. So look at it, at that trail. That's what I'm looking at. And you see that it's started to travel in that northeastern direction, what we really, really like to see. So the S&P seems to be one of the better country indexes among the rest of the world. Go down, Russia, really, really bad. Brazil, Canada, Europe. I mean, this is what I'm looking. This is my day, guys. I mean, the US market only starts like at 2:30 for me now with DST kicking in, but like from 9:30 in the morning, I'm looking at that, these European markets going down. And in case you missed it, the European markets don't have any circuit breakers as they kicked in the S&P, but overall markets in Europe were down over 10%. The stocks index, which is the big one, is 11.5%. But Italy, for example, almost 17%. The UK, 11%. Germany, 12%. France, 12%. These are big, big numbers. So Australia in there, and then you got the global. And then I want to actually start to wrap it up by looking at currencies, because that is something that a lot of people, well, maybe don't look at, but currencies really show what's going on in the world. And if you look at this RRG, this shows you the G10 currencies with the US dollar as the benchmark. So you see that all these currencies are expressed in US dollars. And if you look at the trails, you see that Swiss and the yen are the only ones that are moving in a northeastern direction. That means that they have a relative uptrend against the US dollar. everything else is going lower left. And that means basically the message that this chart is sending is that the dollar is strengthening against the rest of the world. I think for US-based people, that is a good thing. Now, the one thing that struck my mind when I was watching these markets, because I have this quote screen up and everything was like between 7, 8, 9, and then it dropped later in the day to 10, 11% down. But there was on the bottom of my list are a number of cryptocurrencies, and these had all dips that started with a 2, almost 20%, some 30%. So this crypto market lost about 1/3 of its value in the last 24 hours. And that's crazy, because in my mind, it was like non-correlated to the stock market, non-risk asset. Well, and I was just talking to Dave before the show, is that, what do you make of this? And he said, well, very, very rightfully so. He said, well, everybody was wondering whether crypto assets were going to be a defensive non-risk asset. Well, today's your answer. Apparently, crypto is a risky asset. People are selling it like crazy. And what you see here is the RRG of cryptocurrencies expressed in US dollars. And you see that that move started about 6, 7 days ago. And you see them all dropping towards the lower left lagging quadrant, picking up a little bit. And now today is really crazy. And if we look at that table, if I make that like a 1 day, look at these numbers. This is a 1 day change, guys. That is absolutely crazy. So 1 day, and then here you got 10 days, like 40, 30, 40%. Where does it go? I honestly don't know. But what I do know is that it's always best to keep your calm, stay looking at the markets, check into StockCharts TV every now and then, ask Dave and myself any questions you want, and we can deal with them either in the final bar or on Sector Spotlight on Tuesdays. Dave, that's it.
Julius, that was a stay calm is great guidance. It's hard to stay calm as you're showing some of those rotations and how things have been going, but I think it's a great way to illustrate sort of the movements. And I think what you hit on there, you know, there are some places where they're storing value, and the dollar comes to mind, right? The dollar is actually holding up relative to other currencies, and also things like technology, right? That you sort of highlighted are holding up at a time, you know. And again, in a perfect world, it's not my favorite chart, but boy, there are worse places right now, it seems like, right?
Exactly. Oh yeah. It's crazy.
It's a great summary. Julius, listen, I know it's a late evening for you, and thank you as always for joining us on the show, bringing your perspective. Super, super helpful. Stay safe, and thanks again for coming on.
Anytime, Dave, and same for you guys and everybody who's watching. Please be careful.
All right, everyone, that's Julius de Kempenaer joining us from the Netherlands. Always a pleasure to have him on the show. The founded RRG Research, shared that methodology with me years ago. It continues to be part of my daily routine. I encourage you to check it out if you've not used it yet. We need to move on to our next segment, which is the mystery chart. We actually have not done this one in a while, and it's a very timely opportunity to try to, you know, see so many charts right now look very homogeneous, right? Everything's sort of selling off, and I get it. So the question is, what is this chart? And the way that this works, what is this chart? You know, think about what it is, think in your side of your head, right? Jot it down. Later in the show, I will unveil what the mystery chart is, why it's an important thing for you to pay attention to. My only hints, this is a tradable asset in the United States. It's listed on a US exchange. That's it. It's a daily price chart going back 2 years. This is the relative strength relative to the S&P 500 at the bottom. What is the chart? On to our next segment, though, the 2-minute drill. In my previous life, being at a large buy-side institution in the Northeast in Boston, we were known for having what's called the 2-minute drill. Every analyst gets 2 minutes to pitch a stock, and it forces you to boil down your thesis into a 2-minute segment. I'm going to do it right now. My thesis for you is to be long Apple, and I will tell you why. This is a candle glance chart that I look at all the time, which is the 30 Dow members. It's been a great way of just visualizing rotations, and again, putting these on an RRG, really, really helpful. But I also like to look at it on the candle glances, because then you get to see the shapes of the moving averages. You get to see when the market sells off, which names are breaking down, which ones are holding above moving averages, all those sorts of things. And it could be real helpful. And as I'm reviewing in here, there's only one of these 30 names, maybe two, that looks somewhat decent. And there are the few that have remained above their 200-day moving average, and there are a couple that actually have remained above an upward sloping moving averages. And there are two stocks that come out and jump out to me. Number one is Microsoft, and number two is Apple. And my 2-minute drill for you today is for Apple. So, and again, I think what you have to remember in this sort of environment, it's not just about what the price chart is telling you. And in a normal environment, if you buy charts that have good patterns, in general, you're going to do better than otherwise. But in an environment where everything's selling off, you have to look at the things that are selling off less than everything else. And when you look at the chart of Apple, it has only retraced 50% of the rally from June to where it peaked out in the first quarter here in January, and then you're going to retest in February. It's now down about 50%, which again, in it, all else being equal, is a big sell-off, but compared to everything else, it's held up very nicely. It's one of the few stocks that remains above an upward sloping 200-day moving average. Even with today's sell-off, down almost 10%, it still has not punctured that key level. It's been a relative outperformer for a while, and what you would find is a lot of things outperform in an up market, but then in a down market, it does not outperform. Apple is one of those rare stocks that actually has held up very nicely, even given that market sell-off. So it's been a relative performer. It sort of pulled back a little bit last month, but once again, as the market's really capitulated, it's actually been outperforming in the month of first couple weeks in March here. So overall, with a stock like Apple, I think it's at an attractive point. It's one of the stocks that has held up pretty well. As long as it remains above the 200-day, that's a fantastic bet. If it breaks it, I think that 230 level, which would be the 61.8% retracement level, that would be sort of a stop for any sort of long position or long thought. If it breaks that on a closing basis and we get confirmation to the downside, I think you'd want to cut your losses and try to find other opportunities. But overall, I like looking at stocks that have held up. This is in a group that's done well in technology. It's actually held off coming down here. And if you look at the scooter rankings, it's in the top 6% of large cap stocks out there. So my 2-minute drill pitch for you today is Apple. Ladies and gentlemen, we're going to take a quick commercial break. Be back with my next segment, digging into breadth. See you in a minute. Hey everyone, welcome back to the show. Thanks for joining us every day after the close for the final bar. You can get your questions to us, the final bar at StockCharts.com. We'll be doing another Q&A session tomorrow, so we'd love to answer your questions from the final bar mailbag. Just shoot us an email, the final bar at StockCharts.com. Our next segment is called Banking on Breadth. One of the common ways we like to look at market health, market structure is by looking at breadth. And my quick summary for breadth is, the market, the stock market, the S&P 500, whatever broad index you do, what does that do? And then breadth answers that second question. How are stocks actually relating to that overall market movement? You can think of it in one of two ways. Number one, what is the average stock doing? Is the average stock participating in what you see the broad market doing? Question two, or the other way to describe it is, overall, how many stocks are doing what the overall benchmark is doing? And getting those disagreements or agreements between breadth and with price pattern can be really, really helpful. What's happening now with breadth analysis, before we get into some of the charts, is I am finding, and this happens, and again, having gone through a number of bear phases here over the last 20 plus years, I will tell you that this sort of thing happens, and it will happen many times in your career the longer you do this. And I know when we're in a bear market phase, when I have to start bringing in more and more data, I have to go back further to try and get it parallel to where we're at. On a normal given day, what you do is you just look left on the chart for the last year or two and you get some comparisons. You can start to think about how this move relates to previous moves. But this sort of historic sell-off, you really have to go deeper. And so you're going to find a lot of the breadth charts I'm looking at. I'm digging a little bit into more history to try and make sense of things. But I wanted to just go through a couple charts with you. Number one, this is one that is our common way of looking at breadth, which is the S&P 500 and then the percent of S&P names above their 200-day, the percent of S&P names above their 50-day. And again, some of these breadth measures don't update intraday. We sort of wrap them after the close as we polish all the data. But Going into today, you had only 14% of S&P names above their 200-day moving average, which is very, very low relative to what we've normally been. One of the warning signals, two of the warning signals I think we saw was based on this chart. One was the higher peak that you saw in February, the lower peak that we saw in all these breadth measures. That was one of the warning signs, one of the red flags telling you that the market was potentially gonna roll over. And Aaron Swenlin, my guest yesterday, made a great point on a number of charts showing you that divergence. But also when this percent of stocks above their 200-day broke below the 50 line, and for me, going back over a number of years, that a lot of times has what separated sort of the garden variety pullback, like early 2018, with these more severe sell-off like we saw in the fall of 2018. So what we saw here, once it broke below 50, sort of meant it wasn't going to be one of those mid-2019 sort of pullbacks with an uptrend. This was something different. And now we have to start drawing comparisons to historical sell-off periods. And again, what I've seen with the severity of going down, based on just the last 5 years, it looks the most, if you had to compare it, it would look like mid-2015. And I think what was noteworthy there is even though we recovered, we went to a lower low. And every time we've done that over the last 10, 15 years, we've ended up going to a lower low after that initial sell-off, after that initial distribution. So I think that tells you we have more downside coming. With here, we're looking at the stocks making advancers versus decliners on the New York Stock Exchange. So the S&P at the top, this is the basically the percent of stocks advancing versus the total. So only 4% of the S&P, the New York Stock Exchange going higher today, 95% of the S&P going lower. So we call that a 90% down day. Those don't happen very often as well. You can see back here, the last time we had any significant or any examples of this was in August, which is that first big gap down, but that was it. That was the low for that couple months. Now you can see we've seen a cluster of these. Based on this reading, we barely got there at the end of February. This was sort of that initial pullback. Now we've had a big cluster of them, and the more 90% down days, that really shows you the severity of the sell-off and the breadth of that sell-off. So very severe thrust to the downside. This is looking at new highs and new lows, and I'm going back very far. I'm actually going back to 2007 here, to the early 2008, because what I noticed is we have so many stocks on the S&P 500, so many stocks on the New York Stock Exchange going down. To get some sort of historical parallel, you have to go way, way back. So when 40% of the S&P has gone to a new low in one day, which is what we've seen this week, and today I think we'll see a much deeper number than that. We have to go way back there. The last time we saw that was the market low in 2018, but before that, you have to go all the way back to the 2008, 2009 sell-off. And again, I think we're in that sort of environment, in my opinion, in terms of the breadth numbers and in terms of the severity of it. We're getting more into a cyclical bear market territory. This feels less like a pullback within an uptrend and more like a severe downtrend that needs to be digested. Now, as a reminder, markets can correct in one of two ways: in price or in time, or in a combination of both. And I think that's what you want to look for here. It might not just be price; it could also be time. The last one, and then we've got to move on with the show, folks, is breadth by cap tiers. So we can see how the S&P has sold off. We're now looking at the cumulative advanced decline lines. These have turned negative, and again, in my opinion, the bear phase is in play until you see this trend broken. It's lower lows, lower highs on these breadth readings all across the board, large to small caps. Until we see a rotation higher, I think you still have to be expecting further downside on stocks. And folks, that is our segment, Banking on Breadth, trying to break down some of the breadth characteristics. And again, if I could just summarize it, we were at extreme levels we rarely see. I've only seen these a couple times in my 20-year career. And again, I'll do my best over the coming days and weeks to try to put it in context for all of you. But in our next segment, we unveil the mystery chart. Do you know what the mystery chart was? We showed this earlier. This is the chart we looked at. It's been in a pretty good uptrend until the last couple of weeks. And again, I know that the last month has been challenging for most charts, but this is one that's actually managed to outperform. So what is this chart? The answer is the technology sector. I wanted to make this hopefully an easy one for you. And we, sort of teased it by showing you Apple as my 2-minute drill pitch earlier. Also pointed out Microsoft. I think one of the things you found, and also with Julius's segment, looking at the relative rotation graphs, if you look at the sectors, technology is one of the sectors that's actually held up pretty well on a relative basis, which is kind of surprising. But what we're finding is that Apple and Microsoft, some of those big tech names, are serving as a safe haven. They're big benchmark names, so it's plenty of market cap for a money manager to park things in. Overall, when the market recovers, things like Apple and Microsoft are most certainly going to likely reflect that. So overall, it's outperforming in an uptrend, outperforming in a downtrend. A consistent outperformer is something you probably would like to have as a core position in any environment. So tech holding up, the XLK is pretty key. I want to go back here just to the sector looks. Here we go. If we look at the sector ETFs, here's the chart of technology. I just wanted to update it going into the close here. So the XLK finished around 75.35. We're really close to that 61.8% retracement level. That's why I think it's an important one. Even though I still think, regardless, I think it's still a good place to be. If you have a sector rotation strategy, the XLK would certainly be one of the ones I would advocate thinking about. But what's interesting here is it's lining up with previous support as well. This is the low from last August, also lines up with the peak from 2018. This is before the sell-off into the 2018 low. So they have this confluence of levels right around the 74 to 75 level. I think a close below 74 on the XLK would confirm further downside. But again, the relative strength is the line that I would be watching to see if this is able to hold up. So that is your mystery chart for the day, the XLK, the technology sector spider ETF. We need to wrap the show, folks, by going right into the 3 in 3. So 3 charts in 3 minutes if these are not on your radar yet. And I don't know how, if you've watched the show, I think I've touched on these a lot recently, but they're the way you get a read on it. So here we go. The first chart is the overall S&P market trend. This is a market trend model I've been following for a number of years, and it's based on long-term moving averages. There's 2 components to it. The top part is doing the 21 and 34-week exponential moving averages. And then here's the PPO, sort of the difference between those 2 moving averages. So if it's at 0, that means the 2 lines are crossing. If it's above 0, they're still in bullish territory. At the bottom is a weekly PPO or a weekly MACD using the traditional settings. We'll come back to that, but that is in fact negative. So the long-term picture is still positive based on this trend following model. This is not meant to trigger often. And one of the times when this has struggled is during quick sell-offs. And I remember that from most vividly from 2015. And you can see how it turned negative really after the ultimate bottom in stocks was in place, because it was based on the closing levels and how much time it took to process that sell-off. So it gave you some false signals along here. Overall, though, the goal of it is to stay in play during the longer trends and get you out before a downtrend becomes severe, right? And so back in 2001, back in 2007, did much better at getting you out at a decent time. Overall, still positive. We'll have to see when it triggers. It triggered here toward the end of 2018, going into to the market lows. On a tactical perspective, though, the weekly MACD did in fact turn positive about a week and a half ago, remains negative and suggests risk off in the short term. Hopefully you saw that. The second one is a hat tip to my friend Matt Maley from Miller Tabak, a very capable technical analyst who we will be having on the show very, very soon, hopefully. But he shared this chart earlier, which I wanted to share with you. If you use an arithmetic scale, which I rarely like to do, but I love this visual. So it's going back to 2009. If you connect the low from 09, the low from 11, the low from 16, you can see it lines up right about to today's low. It hits around 2,500. So that is a really interesting support level. If we break that trend line support, I think pretty clear. And I mean, from all of my reads, I think 2,350 is the next major objective. And from there, I don't even want to think about the next levels. We'll probably be talking about them very soon, retesting some of the lows from 2015 to 2016. And the last chart in the 3 in 3 is looking at the AAII rankings. In our YouTube live Q&A earlier today, we shared this chart. This comes out every Thursday afternoon. The difference between bulls and bears is pretty low. It's at the lower end of the range, over 20%. But what's really interesting, the percent of bears, over half of respondents were bearish. That happened the last time at the end of 2018. And the only other time that had happened besides early 2013, we're getting back to this bear market phase, 2018 to 2011, sort of that bottoming process. And again, one of the reasons why I feel like we're getting down toward those levels. It'll be interesting to see if we get as much of a difference as we saw back in 08 and 09. Ladies and gentlemen, that is our show for today. Thanks again for sticking with us on StockCharts TV as we adjust to things. We have to rotate away from live content. We're going to be pre-recording all of our shows for the foreseeable future. We're going to get you some really good commentary, really good insight from our experts on the team here. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.